We're so close. Markets are almost back to being in uptrends across the board. There was some nasty gapping action into the end of last week on news, but charts are starting to firm up. The final piece of the puzzle is the NASDAQ, but does it have the strength to get back into an uptrend itself? Well, it'll all boil down to a game of musical chairs between Mag 7 semiconductors and software. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today on the SPY weekly time frame, talking about candle structure and location, as we always do. In terms of structure last week, you could see a green-bodied hammer, which would imply that sellers did indeed step up to set this lower wick. However, we know that buyers responded with overwhelming force, pushing prices back up to the opening print, through the opening print for range expansion, and achieving a fairly strong close at the highs of the weekly range. Absolutely bullish as it relates to structure. In terms of location on the bar-to-bar count, clearly a higher low as well as a higher high, and a candle close completely outside of and above the previous week's range. Buyers go 2 for 2 on the weekly bar-to-bar count. And really, if we're thinking about the overarching theme of the weekly timescale, this is the all-time high. It's the highest high in the trend count. This is a massive higher low versus the low of this bull flag. We've also been pointing out how all of this price digestion has been happening well above the Fib 38.2. If we lock this in like that, you can see your Fib 38.2 is here. And we also know, if we throw on the anchored view apps from a weekly perspective, we're even using the all-time high anchored view app as support in the lower wick of last week's bar. So I don't really see a bearish argument on the weekly timescale unless this turns into a look above and fail on the range high, in which case we would retarget the range low over here. But it's probably not going to happen in a single week's worth of trade. I mean, it certainly could start via some kind of upper wick that looks like this upcoming week. That's a possibility, but an overwhelming bearish stance on the weekly isn't necessarily warranted as of right now. I would say that just a straight up breakout is the first idea. Higher low pullbacks over the flag range high and then continuation would look fairly compelling. We talked about extensions on the monthly analysis last week, but if we just come in here with the Fibonacci extension just to point it out again, and again, I'm not arguing for this in the coming week's worth of trade, but 850 is the measured move target of this bull flag. We don't have to go there in the next 5 trading sessions. However, there's room to run is the basic illustration of this measured move. Let's go ahead and take a look at the volume profile from a weekly perspective. You can see we're above, or I should say back above, the high volume node from the all-time high consolidation. So once again, the argument of overhead supply doesn't really work here if we've closed above the high volume node. This looks more bullish than it looks bearish. Let's take a look at the daily time scale here and firstly evaluate this week's expected move. It's this gray shaded area right here. If you're not familiar with the expected move, check out the video tutorial in the top right hand corner. If we're contained by the upper bound, the number's at 764.07, and that of course implies a higher high and a brand new all-time high. If we're contained by the lower bound, the number's 745.83, and that does imply a higher low versus last week's low as well. So expected move is bullish here. The trend has started to flip to up. I'm not a huge fan of trend lines, you guys know this, but if we strike that trend line, which a lot of people are watching, so usually the more eyeballs on something, the better, self-fulfilling prophecy, right? We've broken this resistance trend line, but from my perspective, what we've really done here is we've set a slightly higher high versus this last pivot high that we pulled back from. And we also know that given the SPX and the ES futures, both tradable products, did set a higher low here. This is the rebalancing funky low, we'll call it that. This was a higher low in the trend count over the 50 SMA. It closed back above the 20 SMA. We talked about this in quite a bit of detail in the Wednesday midweek market update video. That higher low is ideal because it happened over the gap close area highs from back over here. I mean, this chart is developing into a new uptrend. This is your last higher low, and you've finally gone out. Instead of range compression, you have a higher high in the trend count. So what does that mean as it relates to the overall trend? Well, the market can either continue towards the all-time high, and that would be bullish, or if the market pulls back, we could afford a higher low against the lower bound of the weekly expected move, 745.83. We could respect the moving average stack as it slowly starts to curl higher here into the early stages of this week, and we'd still be in an uptrend because of this higher high. Generally speaking, I think the daily chart is very constructive on the S&P 500 for higher here. If the bears were really going to make something happen, I mean, at best, maybe it's a double top in here, but you really need to break the neckline. You need to see price action underneath that big line in the sand at 739.65. It just didn't happen into the end of last week. So the base case here is that the buyers are making a stand and we are drifting into a new uptrend on the daily timescale for the S&P. Bullish. If we take a look at the hourly chart here and get a little bit more granular, what would be some tradable outcomes into the early stages of next week? Let's focus on the pathing here. We just set a brand new highest high in the hourly trend count here. We had that nasty liquidation break on the Trump tweet on Friday morning. That is technically an hourly higher low. We didn't really flip into a 15-minute downtrend, but the location of that lower wick is bullish. You could see here as we look left, previous resistance acted as newfound support. So as long as the hourly chart stays above that level at 749s, I would be bullish here for continuation. You could go like this, get a pullback to drift into the prior highs, find some sort of support back to the equal high, consolidate and look to the all-time high. That works. You could just get straight up continuation to the all-time high, in which case a pullback that looks like this would be bullish, right? Even if you come back in like this, you're still bullish there for a higher low and then continuation. That's the upside. If the bears are going to attack this in a major way and we do something that looks like this, and then we break to this low, I would maybe get a little bit more neutral back down inside of this balance range, especially at the midpoint. But again, if the daily chart is in an uptrend now, and this is the highest high in the trend count, and we can afford a higher low, if the hourly chart flips into a downtrend, bear with me here because it's going to be competition of the time frames. If this is an hourly lower high, and this is some kind of a low, and then this is an hourly lower low, we've satisfied the conditions for a daily firm higher low because the hourly trend has to flip to down. It'd be very short-lived, but if we can catch support once again off of those major moving averages, the 20 SMA, and find buyers here, it's your daily higher low. I would not get aggressively bearish into the moving average stack. I would actually look to be a buyer down there. So if the hourly trend flips to down via this configuration we've just drawn in, I'm not convinced I want to be a big player for shorts there. This would be constructive, and then this, working ourselves back up towards that all-time high. So this might sort of usher in the next question, well, where does the thesis break, and where do we actively have to become bears? Well, if you naturally have a more bearish tone for this market, if you're a non-believer here, you want to be trying to get short up here on really tight risk. Something like that starts the trade, and then if you're lucky, you get that follow through to the downside. I would say if you're waiting for the market to look like this, and we're in here at the moving averages and then we break those moving averages and we're consolidating, you probably don't want to flip bearish smack on the lows into this area of support, but it would be bearish in the sense that if the market tries to rally, sets a major lower high versus this high, and then breaks through all of these equal lows, which has been the key level for a while now at 739.65s, that's where the bears really start to take control of this market. And we sort of look at all of this and say, wow, overhead supply, distribution, pattern traders rejoice. Maybe it's some kind of head and shoulders or whatever, but it's going to require quite a bit of work from the sellers if this chart's going to roll over. Put it in the perspective of this, if the sellers were really going to attack it into the end of last week, it should have just been this. There's your head and shoulders. You get a lower high consolidation instead. You disregard the moving averages. And then this week, we're lower under 739.65. It just didn't happen. So the first thought is, okay, pull back, and we're really looking for higher lows and continuation rather than outright Armageddon, right? Let's come in here with a Fibonacci on the hourly from the low, pullback low, up to this high, and just point out that once again, as long as we're kind of over the 61.8, which is always the line in the sand when it comes to Fibonacci analysis, if we're above that, right, and you're pulling back into the moving averages, I would look to be a buyer around this area. Once again, that number is 745.83. This is a great spot for buyers to defend the lower bound of the weekly expected move. You can kind of see the chart structure in here as well, the lack of lower high after the gap down on Wednesday. As long as we're over Wednesday's high, this number, once again, I'll say it one more time out loud, 745.83, we're actually in pretty darn good shape, staying over the moving average stack, seeking a daily higher low, even if the short-term hourly trend flips to down. Again, do not get bearish at the lowest low of the hourly trend reversal if we're in a daily uptrend, right? That's not typically how you want to trade that. Let's come in here with the final piece of supporting evidence on the hourly chart, which of course is the intraday anchored VWAP stack. Notice that we're above the entirety of it, and as the week wears on, the more volume that can get transacted up here, and mind you, it was an incredibly low volume day on that Friday session, but if we just go back on over to this, If this slowly starts to drift as a stack higher here, you're just building the narrative of confluence of support near this 745, which generally, once again, my view is that when and if markets were to pull back into it, we're seeking higher lows there rather than just a knife through, or a hot knife through cold butter. Let's frame it that way. Use all the temperature gauges. What else can we see here? We've anchored a VWAP to the gap down level from the Wednesday open. That's this yellow dotted line in here. If the market's really shallow on a pullback and looks like that, it's just telling you everything you need to know. If the pullbacks do not get deep, if we do not get hung up in the moving average stack, if pullbacks are shallow and met with aggressive bids, you have buyers on the table here, and we're sort of breaking into this more firm uptrend. Let's take a look at the market internals. If you're not familiar with the market internals, check out the video tutorial in the top right-hand corner on how to set this up, what it all means, the whole 9 yards. As we take a look here, Wednesday was fairly bearish, right? If you take a look at the exchange level data, and we called this out on Wednesday's midweek market update video, it was one of the more bearish sessions that we've seen in a very long time. And so, the next thought process becomes, did the bears actually do anything with that damage? And the answer is just clearly not, right? Buyers step back in, buyers step back in, buyers step back in. It kind of speaks for itself. A little bit of a mixed bag on Friday. But nonetheless, price action itself is supported in going higher. Rather than, oh my goodness, bears are actually breaking something at the exchange level, it was like a one-day flash in the pan on that headline that, oh my goodness, the MOU is over and we're going to be, war is going to break back out. We'll keep an open mind to headlines, but you saw the same thing happen on Friday. You got the big war headline like, okay, we're basically, done with the ceasefire with Iran. Trump tweets that via Truth Social, right? 100% retracement and some into the close. The market just doesn't care anymore. The market doesn't believe. The market believes that there's going to be de-escalation and, oh my God, this is going to be over. And just like any big dip from the war headlines ends up turning into a buyable opportunity. So if we had stronger sellers, let's just, again, put ourselves in their shoes. You want to see this market get absolutely smacked on that headline and then stay weak, rally into a lower high, and then take out the low. And it just isn't happening, right? And again, frame it through the perspective of Wednesday. You go gap fill reversal straight into the major support and then get bid straight back into a new daily higher high. That's bullish, right? So on pullbacks, now that we've resolved this daily trend count, I do believe we are a little bit more so in the clear now on the S&P 500. This was pretty shaky over here. This looks a little bit sloppy, but ultimately a daily higher low, great. And now we have the missing piece of the puzzle. We do have the higher high. Now, is that where it runs out? Well, let's take a look at market profile before we jump on over into our, maybe we won't be looking at market profile. I'll see if I could throw in a screenshot on top. So I'll pause, screenshot, insert now, and I'll annotate it. And now let's jump on over to the QQQ. And this is where sort of the problems start to emerge, right? Let's go on over to this weekly chart. Let's clear this up with a clean drawing set. And we'll start to see that the picture is not quite the same over on the NASDAQ. I do like the weekly structure, so let's keep it simple. Let's keep it according to the plan and process as always. You've got a really long lower wick on this hammer candle, so once again, sellers step up, buyers respond with overwhelming force, expand range into a new weekly high. But look at where we're at in the weekly flag. We're just still in the midpoint here rather than closing in the upper third. It's not the end of the world, and certainly don't get me wrong, I'm not bearish here on the weekly timescale of the NASDAQ. I'm just pointing out that there's a subtle divergence with the S&P 500. As we take a look at the Fibonacci's, of course, we're above the entirety of the 38.2, doing something that looks like this. And if we jump in with the weekly volume weighted average prices, we did close back above the all-time high anchored VWAP, but notice that the lower wick does flirt underneath that and test the bottom end of the range there. If we throw on, so just again, another sign that's not quite as bullish, but I wouldn't be bearish here necessarily on the Qs. Let's go to the weekly volume profile. Let's just get this thing off the screen as well. Where are we relative to this high volume node? If you want to split hairs with me, we've technically closed above it, but there is some opportunity to say that we're just still inside of the overhead supply. We're churning in here rather than cleanly above it and threatening the possibility of people being positioned from underneath and a successful breakout being sort of fueled by those people who are positioned from underneath. The NASDAQ just has a little bit more work to do, and it does become much more obvious as we reset to a daily timescale chart here. and jump on into our expected move first. You could see here, there is the upper bound at 742.89. That is technically a higher high versus this pivot high. You could see here that the lower bound is 708.13. That is a higher low versus this pivot low. They'll look below and fail from the Wednesday gap down. So expected move does strike me as being an improvement. It is not suggesting a new all-time high. So we'll be like neutral to bullish here on the expected move. In terms of the daily trend, this is where we can also see it's not as clean cut. You've got yourself some opportunity still for a daily lower high. You are not resolving the daily trend yet. We also know that instead of sticking a daily higher low, we did experience a look below and fail, which I will acknowledge as being a bullish pattern, because technically what should happen there is that you break this set of lows, you invite sellers to get active there, they should yield a lower high underneath, and then you continue lower. It simply didn't happen, so we take that as a slightly more bullish data point. I was a little bit more skeptical headed into the end of the week, especially after Wednesday's close, being underneath the daily 50, underneath the daily 20, but as you can see into Friday's close, we actually go for a partial gap fill reversal, close at the high of the session, just sort of like pull back in the morning session on Friday, that sort of Trump headline, right? And then we rally higher to close over Thursday's high. It's not even an inside bar, and we leave this gap unfilled below us. So although we're not technically in a daily uptrend, and again, not a huge fan of trend lines, but you could do something that looks like that, we haven't broken a trend line yet. I would like to be slightly more optimistic on the NASDAQ. And if you go back and watch all of the videos, the Wednesday updates, the Saturday updates, the morning preps, right? I've been using this term. I would like to be optimistic about this market, right? I would like to be more bullish on this market. I don't believe the AI trade is just going to like fall out of bed and go to zero tomorrow. But, now we're finally starting to see a little bit of an improvement. This is like a super big headache over here. You failed early last week. This is like pretty tough. Now we're bullish with the close back over 722, reclaiming the moving average stack. And I believe that this is more likely to break in the upward direction and become bullish again rather than completely fall apart. However, I do have to acknowledge I'm going to be extremely neutral if the market goes like this. Look above and fail on Friday's high, back below 722, closes the gap, consolidates towards the bottom of the range. If we get something that looks like that, how can I be bullish there? Well, maybe on another look below and fail. You really don't want to see that twice. It's like it happens once and you should go, right? Because sellers get stuffed down here. If the sellers are like, no, we still got lower highs, we're back down into an equal low again, all we're going to do is just say, okay, we're going to move the breakdown point ultimately to being underneath 700. You lose 700, right? Maybe it's consolidation like this, and then wow, oh my goodness, bears, right? Now, this is a hypothetical. We're not here yet. What would the chart suggest at face value currently? Well, probably something that looks like this, a little bit of a drift higher. If we could set an equal high in here, that would be ideal. So let's draw in the ideal situation. Drift higher. I mean, how much can we ask for here? This is day 1, 2, 3. You're asking for a day 4 continuation in a neutral daily trend. I mean, it's not impossible here, but if we get a day 4 continuation, we're here, we pull back, we firm this 722 up as a higher low against this. That would be the ideal outcome. Build out what? This would just kind of be like range, low, low, higher low. If you could build out in the upper 50% of the range, now we're bullish back to the all-time high like that, right? That's one potential scenario to get bullish here. The alternative would be that we do get this look above and fail, but we go gap fill reversal. That's your daily higher low, which would still be bullish. And then where's the trade? It's back above 722 after the higher low to continue the trend, hopefully at least to the 726.50, if not to the equal high here at 735.25. Let's drop this thing down to the hourly chart. Let's see what other nuances we can pick out from this. Again, I think the biggest thing here is just the lack of the gap filling to the downside on that Thursday session. You open up, you experience vol up and down. Where do you close? Strong, right? Highs up here towards the top of the move. You take a look at this sort of Friday session, you get volatility on the Trump tweet. It doesn't even take out Thursday's low. You're above the 50 SMA. The gap remains unfilled. Remember, if we have strong sellers, what should happen here is that you rally into the 722, you fail underneath the opening print, closes the gap to reset the inventory, right? You get a bounce. You set another lower high, you're back down here, and suddenly the pressure's on like that. If we had bears involved in this market, this is what should have happened, and that's not what happened, right? So instead, we take the alternate angle, as we did with the spiders, and we say, okay, what are the outcomes? Well, this and this and this is bullish. Now we have an equal high on the daily time scale. We can afford a pullback, consolidate, and go. Oops, lost my mouse off the mouse pad. There we are. That's good, right? We can also say, as we just said, something here, gap fill reversal is still a higher low there, consolidate. I would be bullish on the reclaim of 722 and then looking for that same upside path. If we do just get a rally to start, I would not be a new money long into the equal high. I would look for a pullback off of this level. Let me actually start that again. So if we go higher first instead of those pullbacks, higher first to here, I would look for maybe some sort of a topping pattern, pull back there, and then we continue, right? That's the look. I would not start forcing new money longs into this equal high. I would think that would be a great spot for people who are long off of this low. They're going to say, wow, look at this. We're coming up on a left side peak. Let's take some profit here, right? That causes your pullback. Then we try to get long here for the daily high or low. Right. And then, of course, the bearish situation that we've already sort of talked about is, okay, you fail in here. The gap doesn't really do much for a reversal. You come down into the equal low, consolidation underneath the Wednesday high, so 712.35. That's where the bears have it, and then we start talking about downside outcomes. I would think there's lower odds of that, but it is something that we should have in our back pocket. Let's go ahead and hit this with the intraday anchored VWAPs just to see where we're at, because we are not quite as bullish as the S&P's intraday anchored VWAPs. There we go. We're above the stack. You could see how 722 is important here. You could also see how there's some width to the stack, right, in this zone. So if we do pull back for that gap fill reversal, it would still merit a hold. Depends on what day it happens, actually. Depends on how quickly this flattens out here with the anchored VWAP off of the Trump headline day, Wednesday's open, basically. If we can get some support that quickly looks below and recovers the anchored VWAP stack, that's where we're bullish back up through 722. As an alternative, right, to offer up the bears something here, if we drop the anchored VWAP stack and then use that as resistance for lower highs, pretend your yellow dots continue like that, right? If that then turns into lower highs, that's where we say, okay, through 707, the floodgates open up. We're talking 700 pretty quickly, right? That is the cues on the intraday. Let's take a look at the NASDAQ internals. If we could get this to load, that would be beautiful. Here we go. This is good enough. On Wednesday, we didn't really see a ton of sell-side pressure. There we go, slow to the load. But we didn't see as much sell-side volume here. But look at the inflows on that Thursday gap up. That's a pretty compelling story here. And the market even drifts higher, even though the volume flows are slightly out. This is not a bearish, like, oh my God, run for the hills situation on Friday. But they are outflows, and yet the market rallies. Same thing here, advanced decline line. Look at the cumulative tick, completely flat there. So again, it's like, I'm not as bullish in the NASDAQ, and you guys know this if you've been hanging around the channel for any period of time now. We know that the rotation trade in the S&P 500 continues to keep money moving around between financials, healthcare, and tech, versus in the NASDAQ, it's like, as we said in the intro, it's Mag 7 semiconductors and software, and those have to play in concert if this is going to sustain any sort of really strong movement. You know, it basically has to be a bid across all three of those subsets of technology. Let's jump on into, let's skip the market profile. I'll actually throw up a screenshot in 3, 2, 1. There's your screenshot. And let's jump on into the small caps and see what's going on in small cap land. Going back on over to our IWM weekly chart, clean. And let's just throw on our study set real quick. And there we go. So in terms of candle structure and location, it's a little bit different here. Notice the red-bodied bar on the hammer. So we do see downside pressure. Buyers rally it back. However, as we know, it's a red-bodied bar, so the close is underneath the opening print. Not as bullish, but still represents a look below and fail if we're thinking about bar-to-bar location count. Look at the lower low. Look at the lower high. That's bearish, but where do we close? Back inside the previous week's range. So is it the end of the world? Not really. We've pulled back from the highest high in the trend count. This could easily be a weekly high or low here. Is this just a little flag that's forming before we potentially get some sort of a breakout? It's possible. We know that all of this is happening over a Fib 38.2, especially if we pull from that low up to this high. That's great. If we pull from these major lows up to this high, notice that the wick is right off the 38.2. And if we come in here with the anchored VWAPs from a weekly perspective, we're above the entirety of the stack, actually using the wick low as support off of this pullback low anchor, and this was the breakout bar, right? That is acting supportive as well. So all things considered, I can't really be all that bearish on the small caps weekly chart here. If we go to the weekly volume profile, where are we relative to the high volume node? We use it as a support. So once again, looks okay. If we drop it down to the daily chart here, I do just want to continue pointing out that although the trend is up, it's very, very grindy and noisy, and you're probably not having fun if you're long small caps. It's like one big step forward, half a step back, one step up, 3/4 of a step back, one step up, one step back. It's like you can see the noise, right? You see the noise in this upward trending channel. Nonetheless, there is your hold of the previous left side peak on the Wednesday gap down. You can see the recovery, and also look at the Friday session printing a hammer here over the 20. I've preferred to take a simple approach on the small caps and just sort of say, In this box, we're neutral to bullish. If we break out, great, we're bullish. And if we pull back in here, you get one final chance at the daily 50 SMA to keep the trend up on the weekly based on sort of this notion of a higher low. But that's about it. I would really try to keep it simple. And the levels that we're going to sort of use for that, 299.50, 292.50, and then 288.50. Keep it simple. Those three numbers will light the way on the small caps here into this week. If we're in this range, great. We're again, why do I even have to bother re-saying the same thing? Let's go to the hourly chart. Some may argue that we're going to be working on a head and shoulders here. I don't think that's the notion of how we should approach the market. I do think that as of right now, if the sellers are going to make something happen, look at the break, and we'll just analyze this a little bit. Look at the break on this move from Wednesday to gap down and stay underneath the overhead supply. You would think if you had strong sellers, because you opened right at the overhead supply level, that's 295.25, excuse me. You would think that's your lower high, you're here, and then, you're breaking down. And ultimately, the pattern would be H, but underneath the key structure, right, which is all of this, overhead supply, support, 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 then turns resistance. Well, look at what happened into the end of the week. We reclaim, pull back, support, not quite as strong as the S&P or the NASDAQ, we know that, but generally location-wise, we're over the key reference. So how bearish can I really be? Probably more neutral, like neutral to bullish, as we just said on the daily chart, in this balance range. So again, keep it simple. Let's drop this thing down with a intraday anchored VWAP stack. The anchors are a little bit less meaningful. They're still the same dates and times as some of the other references from the S&P, but you can see we're inside the stack here. You can kind of see how this would preserve neutrality. And if we get above it, we're more bullish. If we get below it, you get one final shot at the daily 50, as we mentioned, and underneath that, you can kind of kiss it goodbye. That's where we have a serious change in character. Let's drop this thing into a internals look for the Russell. Give this a moment to load. Gotta love it. There we go. And on the Russell internals, we could see kind of a similar picture to the other indices. Maybe a little bit more bearish on that Friday from a volume flow perspective, but pretty neutral on the advanced decline line, and even bullish here on the cumulative build out of the ticks. So I can't really fault the Russell, all that much for doing anything wrong. It's just kind of it's holding up inside that neutral balance range, and until something changes, I think we'll just leave that be. Let's go back from these internals over to our supporting evidence categories. Again, I'll just pause for a second and insert a screenshot of the market profile. 3, 2, 1, and we're moving along into our supporting evidence, which begins, of course, as always, with our S&P sectors. Let's just zoom into this S&P chart so we could see what we're looking at index level as it relates to our performance. Who was leading, who was losing, and where was the weight? You can see energy up here at the top of the pack, up 3.81%, followed by Mag 7, 3.55%, and then the XLK technology sector outright, up 1.71%, Then snuck in there at the fourth position is the XLC communication sector. Bottom of the barrel is DRAM over here, memory names. You can see XLB Materials, lightweight, and then XLI Industrials down 1.51%. Overall, the risk on versus off picture is kind of muted in here. I like that the Mag 7 has really picked up. If you're looking at a performance metric there, the 3.5% versus the DRAM down 3.5%, to me, is more meaningful in the Mag 7 ETF because the Mag 7 is just a heavier weight component of the S&P 500. It also speaks to risk on, right? So yes, DRAM, extremely, highly specialized, and one of the reasons for the market to be higher over the last little bit, but this doesn't strike me as being like overly risk-off posture, I suppose is what I'm getting at here. If you look at the XLE, looks like a lower high to me. I would be looking for a lower high here. I know there's a hammer. I know we have this little range, and possibly this is a little Brigade bolt retest like that. I think the market's going to look through the escalations on the Iran war and instead say, okay, you've got a lower high here, look above and fail, and then we start repressuring that 53 for a sort of sustained amount of overhead supply here as crude futures continue to move in the downward direction. If you look at the Mag 7 ETF, this is really, really constructive. I'm actually amazed at the amount of strength, dare I say, into the Friday session there. Look at the gap fill reversal over the 50 SMA, and look at this as perhaps, inverted head and shoulders neckline break. Very, very impressive stuff. I mean, thanks Meta for basically all of the work there, the heavy lifting. Very bullish here, and an opportunity to either consolidate, pull back and offer a higher low and then continue, or just continue, then pull back, right? And you have a higher low. So this looks phenomenal here on the Mag 7 ETF. I love what I'm seeing. I don't know that I would be a new long chasing this at the highs, especially into this previous overhead supply, but maybe a little bit higher, pull back, and then you start looking for a daily higher low. Ideally, the number's 67, and we stay above that, do something that looks like this, but you could pull back into this right shoulder, still firm up a higher low, and seek some kind of continuation. Let's move along to this XLK. I do like what I'm seeing with the unfilled gap. I like that we have some potential for, it's not a true inside bar, but 2-day range breakout up and over the 2-day highs at 186, bullish for the broad market, looking for continuation higher. If we do look above and fail, I would make sure that we go daily high or low against this gap fill reversal at 181 and the daily 50 SMA to remain bullish. If we look at the XLC, thanks Meta for the insanity into the end of the week, but big gap up here. I think we need to see this structure tighten up before we can make a determination here. However, at face value, that's a higher low. Consolidation and some sort of continuation would look very similar to the Mag 7 ETF, right? So watching this 110.50 level very closely here on the XLC. Let's go on over this SMH and see what's going on with semiconductors. I've got to say, bullish improvements, but not out of the woods yet. Why do I say that? Overhead supply still remains here at 610s. I like the fact that we went gap fill reversal. I don't think semiconductors are, like a done deal in terms of the story. I would prefer that we could start treating this as a daily high or low, and we start to really reclaim the 20 SMA, tighten up over here, start breaking back up towards highs. If we're bullish, that's what we want to see. If you're a bear, you're like, no way, this thing's going to fail. And then I would be concerned back underneath Friday's low, basically. You take out the 50 SMA again, and I think the pressure's right back on. And honestly, at face value, you have highs, and a lower high. So fail in here, underneath the 50, what have we done other than really set up the big old head and shoulders pattern, the Man Ray pattern? Dare we draw in some eyeballs and a mouth in here for Mr. Man Ray? The only thing to remind yourself of on the Man Ray pattern is that this has a history of really disappointing on the Man Rays. Let's actually draw that right shoulder a little bit better there. Disappointment, oops, and we're higher, right? If you want to go way out on a limb and say like this is head and shoulders, there's your neckline, oops, and then we're higher. So, if we do get a little bit of that look, let me frame it this way. One day under the neckline, and I'm not going to be a bear. We've seen this story too many times to be fooled. Just like the Who said, we won't be fooled again. The oops comes around, then we're higher on semis once everything resolves. So for now, I just need to see the improvement over 610 and at bare minimum hold Friday's low. Let's move on over to the software ETF. Balanced out in here. I think constructive, but you're going to need to show me over the 200 SMA. You're going to really need some leadership to return over to a Palantir, over to an Oracle. Microsoft needs to stop getting its teeth kicked in. You're really going to need to see those premium software names, not your Workdays, not your Monday.coms, not your CRM Salesforces, not your ServiceNows. Forget about that stuff. You need cybersecurity, you need Palantir, and you probably need Microsoft, right? And then also like data center names. So Oracle, NBIS, NeoClouds, that type of stuff, right? If we can get that up and through the 200 SMA, great, fantastic. But unless that happens, really big failed breakout, kind of a lower high underneath the declining 200 SMA. That's, let's not forget just simple basic technical analysis 101 under a declining 200 SMA probably isn't that bullish on a higher time frame, right? Let's jump on over this DRAM. DRAM is very similar to the SMH ETF, probably worse though. You didn't even get into this overhead supply here. We had the listing of SK Hynix on the NASDAQ exchange on Friday. That sucked a lot of liquidity out of some names. Initially, it did flood right back into your MUs and SanDisks of the world. We'll take a look at those charts, of course. But for now, this is number one of the most funky charts I've seen in a while. Speaking of, in the intro, we were talking about crazy gaps. Gap down, gap up, unfilled, now filled. And it's all over the place here on DRAM. So, if you're going to take a more simplistic approach to the market, good above, bad below, right? So it's over 66 improves and under 57 really deteriorates. Let's move on over to the XLB. Not much to really talk about in some of these less compelling sectors, midpoint of a range there. If we look at the industrials, I think you have the potential for a higher low here, which is bullish. It's great. Let's move on over to this XLV healthcare. I think you've pulled back nicely. Is this still first flag-ish attempt? Maybe. I would want to see some sort of look below and fail on 159.64s. That would be bullish for potential higher low in the count, or just let the market kind of go sideways, let the 20 SMA start to catch up, and then if we can continue to launch off of that, we'd be bullish in the healthcare sector, and the rotation would just continue along. Had to put to bed Eli Lilly this week, and we'll see if it's going to offer another opportunity. But for now, some of these things are pulling back as you're getting a rebid over in your, let's just go to the XLK. If they're just going to sell the healthcare names and rotate straight back into tech, do we get that as the XLV pulls back? That would certainly be bullish for the S&P 500, right? Let's go on over this XLP. No comment, middle of the range. Let's go on over to the XLU. no real comment, just kind of compressing in this range here. I guess staying over the moving average stack is generally bullish. Real estate, again, no comment. Let's move forward. XLF looks great. We're headed into financial earnings. Big bank earnings will kick off this week. JP Morgan, Morgan Stanley, Goldman Sachs, Bank of America, Citibank, I believe, Wells Fargo. All those guys will report. Check out this look. I think it's pretty bullish here as a flag towards it's actually the second flag, so I don't know how bullish we should really be. Second flag isn't usually as powerful as the first, but your all-time high is right there at 56.50. So generally, the trend is cleanly up. You've got a really nice series of higher lows, stair steps higher. I think this could go higher from here, or at least just maintain a bullish look as long as we stay over about 54.50, building out a new block of price action and acceptance higher. Last but not least, XLY, another one of these sectors where I would love to have something more compelling to tell you, but we're just in the middle of this range. There's nothing to say. I would like to be bullish in the upper 50% and look for something that looks like that. I would like to maybe have a bit more of a bearish edge and look for something like that in the lower 50%, but we're literally at the moving average spaghetti, so do whatever you want with that. Let's jump on into the market ratios, sector ratios. Just get a feel for risk on off. If you're not familiar with ratio charts and Thinkorswim, check out the video tutorial in the top right hand corner. XLK, it's trying to be the glue holding the market together. A little look below and fail there, not the end of the world. This still looks okay. So I'll go neutral to check mark here. This is a problem. This is a problem. We know this is a problem. We know this is neutral. This is neutral over here. So it's not full blown risk on, but it's also not risk off. It's not like run for the hills and oh my God, sell everything and rotate into defensives. We're not really seeing that. If we look at this SHY ratio up here, I mean, this is fine. You didn't really make a new low. You can see here that we are staying above those lows after undercutting. It's a little bit more neutral on this front. You can see here we're trying to rebound. I'd say this one's a bit more problematic. This is suggesting a little bit more of a risk off look, which is not anything that we're unfamiliar with, right? We know that it's been a little bit more turbulent in the market. If this can show an improving look back over the low set over here, this would start to look better. And if we see that improve as the market's moving forward, we should continue to remain more confident in that long-sighted thesis on the semiconductors, aka AI side of the trade narrative. If we look at the RK, Kathy Woods, you got to show me a higher low, like ASAP on Monday. Show me a higher low, Kathy, and we'll see what we can do. Maybe this goes double bottom on Russell 1000 growth value, but one more time, just to continue sort of meandering through the data points, it's like, there's nothing in here that's like, oh my goodness, run for the hills, the markets are going to go to zero. Look at this ratio breaking out TLT versus the S&P. I mean, that's not risk off, right? That's more risk on. If you look at the gold ratio, nobody's rotating into flight to safety. The Bitcoin seems to be doing okay. That's right. I did call it the Bitcoin like an old man. If we take a look at HYG Dr. Copper, I don't love the undercut, but it is reclaiming. So if we go look below and fail, target should be the top end of the range, and that's bullish for the AI trade, right? So we look okay. I wouldn't say great, but we look okay on Dr. Copper. Dollar and interest rates, I still think this is a flag, unfortunately. You got to show me price acceptance underneath $100.50 on the dollar index. Prevent this flag from breaking out, because if we break out here, that's going to be a headwind for markets, right? You could see certainly, and ding, 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 what's your winning catalyst headed into this week? We're about to flip to the economic calendar, but CPI, right? CPI on Tuesday. So here you go on interest rates flagging over about 4.5%. If this continues higher, all we need is a slightly hotter than expected CPI report. Rates are going to be up and you're going to get downward pressure on the market, and suddenly we're right back to playing musical chairs, right? Let's jump on into, speaking of inflation and rates, let's jump onto the Fed Watch tool, which inverted ZT is our 2-year. Basically, this is elevated in the range, so I'm still expecting 2 rate hikes. Let's go on over to this watch tool, and you can certainly see here is rate hike numero uno, and there is numero dos. So there you got it. In the month of March of 2027, and the month of September 2026, expecting some hikes, right? Let's go to the aggregated odds. You can see that it might even be higher for longer into the January month of 27. To start the year, you get a rate hike. I was about to say cut. You get a rate hike. And to start the year, Happy New Year from Kevin Warsh and the Family Feud, as they said in the meeting minutes. Let's go on over this economic calendar. In terms of CPI month over month, year over year, you can see what we're looking for. A little bit of a downtick on the annualized core, certainly a bigger downtick on the annualized non-core. The headline number should naturally come down given the energy deflation that we should experience in the monthly report. If we don't see that, that's going to be a problem. So really one of the main things to look out for in here is your sort of non-core look. Does it respond favorably to the downtick we've seen in crude oil prices? Let's take a look at what else is on the calendar this week. A little bit of Fed speak sprinkled in there. PPI always follows CPI, nothing new there. Warsh is going to testify for the semi-annual monetary policy. That's fine. It's going to be political theater. I don't think you should waste your time watching it. He is a new Fed chair, so maybe there's a small reason to watch it, but that's it. Beige book is always interesting for the Fed nerds like myself. Retail sales, jobless claims, the usual on Thursday. And then preliminary numbers for consumer sentiment and inflation expectations from the University of Michigan on Friday at the 10 o'clock timeframe to end next week. A little bit of morning volatility there at the 10 o'clock timeframe. Earnings calendar for the upcoming week, as mentioned, is going to be loaded with banks. You get Citibank, you get Goldman Sachs, JP Morgan, Bank of America, Wells Fargo. What else is, or who else is in here? BlackRock is going to report, Morgan Stanley, PNC, M&T, right? Who else? State Street, Citizens. I mean, you name it. It's listed here as a bank, basically. Truist, Regions, Fifth Third, right? So a lot of financial earnings reports coming out this week. AEHR Test Systems catches my attention. ASML, of course, catches my attention. Remember, a company like ASML is going to be the first leading indicator that the AI trade is over when they're no longer ordering new machines to build more chips. And remember, right now, the narrative is when it comes to the AI build out, we're constrained. We don't have enough capacity to sell. Amazon, Meta, Microsoft, all the hyperscalers, right? They're like, we need to build more. We're investing. All this CapEx is so we can actually serve the demand that we have. If that goes away, your first sign of it is when they start to pull back the orders from companies like ASML. When they pull back the orders from, it's not listed here because it's not reporting yet, but AMAT, Applied Materials, right? When those materials and manufacturing components for semiconductors get the pullback, that's like your big first warning. And, that's not a genius trade brigade. Hey, Matt's so smart. Pay attention to that. I mean, you got to be living under a rock if you don't think that they've got JP Morgan analysts, Goldman Sachs analysts who have been on this for like months, if not years, modeling this in 100 different ways, right? But for the common folk like us, we'll just watch to see how the market responds to ASML earnings, and we'll get our answer on that day. So Wednesday pre-market, very big day for the market. Let's see how they ultimately come in and tell us whether or not, and again, here's another one. TSMC, how could I have possibly forgotten and overlooked that one? TSM makes all the chips. If they're like, hey, we're not getting the calls anymore that are like, can you build this? Can you build this? Can you make this? Can you do that? If they're not getting the calls, then we'll find out. Now, I'm not forecasting that. It certainly doesn't seem like it based on what Meta just said into the end of last week, but that's the sort of fundamental look here. So we're paying very close attention to ASML, TSMC, both pre-market earnings Wednesday and Thursday respectively. Netflix has been trading like an absolute dog recently. Don't care about Netflix, and that's going to do it for this week. It's financials, ASML, and TSMC. Let's move forward into our other supporting evidence here. Let's wind this down into the back half of the video. Inflation impulses are coming back. That's really based on Fed commentary and maybe the small uptick we've seen in oil. I think that'll just easily rotate back to the downside personally. If you look at your credit spreads, you're breaking out on these medium-term credit spreads. The short-term, the SHY, HYG, in my opinion, is the more stable to be watching. So it's doing okay, but this is certainly a first sort of warning shot across the bow. Little white flag. We'll pay very close attention to that. If you're going over to the junk bonds, they continue to offer a little bit of a bearish divergence, but remember, they were bearish the entire rally through April and May, so I don't know how much emphasis I'm putting on that. Remember, it's been a better bottom finder recently, so we'll use that for a bullish divergence if one shows up in the near-term future. Looking at total breadth, let's jump into our moving averages and new highs versus lows. Breadth improves into the end of last week. New highs versus lows stays positive over the zero mark to close the week out. If we look at the RSP, I mean, this looks like a bullish breakout, does it not? You failed it once, you set a higher low, you're pressed right back into the level. All you need is a little bit of juice early on in the week. You're probably higher here on RSP, and that looks good and bullish for markets. Even the QQQE, which I've been putting less and less emphasis on really because it just trades almost like a mirror of the NASDAQ 100. And we're really talking about 100 products anyways versus a more diversified basket where the weighting matters and impacts a little bit more. Nonetheless, I bite my tongue and I sort of come back to this and I say, this isn't a bearish chart. This looks fine as a little flag up here. Let's jump into some volatility measures. Just kind of finish on volatility. Getting crushed. We haven't been crushed for long enough. This continued downtrend was what allowed the Bollinger Bands to get so tight down here. We could probably start to tighten up, honestly, the Bollinger Bands, but honestly, you're going to need a little bit more time in here if these Bollinger Bands are going to get down towards 16. Remember, this is the Bollinger Band width, by the way, if you haven't, we basically have talked about it forever on the Trade Brigade show, but I never actually had the study up. This is what we call the complacency effect, right? We get down towards 16, you have the complacency effect, and all it takes is a tiny little spark, and boom, you experience volatility, right? So anyways, that is the VVIX. Let's jump in, that's the volatility. Let's go to VVIX, volatility of volatility, lower in here, which makes sense. And if we jump on into our vol futures, you could certainly see as they load, we've got ourselves really strong contangos across the board, which is just bullish as, at face value. The one thing I will say is that this also echoes the Bollinger Band width and complacency effect. Typically, you do not hang out here. You should not be at 1.36 points of contango on the vol futures. More respectfully and sustainably, you're at like maybe 0.7 to 0.5. Right? And that's a bit more of a comfortable spot for those vol futures to be at. So, it just means that everybody's throwing caution to the wind and nobody's really bought downside protection. Doesn't mean that the market's bearish, but what it does mean is when and if people start reaching for that downside protection, it's going to come hot and heavy, right? So please pay attention to that as it relates to volatility. Let's jump back on over to the platform here with a reset to the daily charts. Let's buzz through the core list of companies, and I've got 3 additional trade ideas for you. First one, first core list name is, of course, none other than NVIDIA. Really strong. I'm actually very impressed with the move on Friday through the 50 SMA. I thought it would have faded and pulled back off of that. I was, advocating for like, hey, I don't know about new money longs up here, and yet there it is, closing up at 212 to end the week. Really great. I mean, a classic pattern, bullish 3-bar play over the 20 SMA after breaking through this little range here. So, really textbook stuff for higher. I would think that it does need a new higher low pullback before possibly going higher. And then what did I just draw? Pattern traders rejoice. You're over 212 and you're breaking out back up through this thin structure towards about 225.25. That's the major daily spot. There are a few tiny levels in here that we'll pay attention to. Feel free to screenshot or write those down or whatever, but that's the main idea. If you wanted to trade this short, I would look for a look above and fail, and then I really wouldn't overstay your welcome as we approach 203.80s. That's where I'd sort of say, okay, that would be the ideal daily higher low for then higher on this chart. Let's jump into this Apple. Apple is offering a beautiful bull flag here at the highs. It's really nice looking. The thing about Apple, and it did it back here as well, right? You might get some failed breakouts, especially, and I know this is maybe not a popular opinion, but Apple, as pretty as this looks, if they're going to stuff money straight back into the semiconductors and, get risk on that way, Apple's the old man of tech now. It's not the risk on look. So if we consolidate here, or if we try to break out and you notice semiconductors have a bid, don't be shocked if Apple fails the breakout, comes back in and just kind of noodles around. When Apple excels, it excels because everybody's scared of the high beta tech and they're like, okay, give me the old granddad here. Let me go back into Apple, right? It's like the equivalent of holding cash. I think Kramer even said that through COVID. Ooh, I don't know if I could say that these days. I think I can, but anyway, just be very careful about trying to buy this Apple bull flag breakout. You've seen it fail a number of times as they rotate right back into the AI high beta stuff. Let's get into this Microsoft chart. Real sloppy. Like, you show me a big sign of life back over the 20, pull back, really tight day on Wednesday to gap down on Thursday morning, brutal underneath 380. And then intraday to rally back and close above, then to gap up the next day. So like, kind of brutal price action in terms of respect for levels. Don't love that, but at face value, what is it doing? It's got a low, it's got a higher low. Great, can't be bullish there. If is this going to be a higher low double bottom, well, then you're back to bullish, back through the neckline. So 396.75s, consolidate in here, tighten up towards the top side, reclaim the 50 as this starts to come down. I mean, I could envision that, right? It's just a matter of does it do it now? So we'll watch out for it. If it comes back below 380, I gotta say, I'm not really that interested. Below 380 is no good. You gap down, you gave it the chance once for the sellers. Now that you're back above, you have to hold it, which is basically Friday's low anyways. Let's jump on over to this Amazon. A little disappointed in Amazon, trying to get a gap fill reversal there to go into the 50. No dice on Friday, so we just got to allow it the opportunity for another daily higher low, and then maybe try it over the 249.50s into the 50, or maybe it's just so sideways that the 50 SMA starts to come in, just like Microsoft, and then it's here for a super resistance sort of break, if you will. We turn it into a super support, Brigade bolt above. We'll watch out for that. There's your inverted head and shoulders. We could see whether or not the pattern wants to shape up that way, but that's the idea. If we're just noodling around in here, not interested. Moving along to the Googler. I like the opportunity for a daily high or low. Show me the break through Friday's high inside bar, and I'd love to trade it back up towards the 50. Then you have yourself pattern traders rejoice. I mean, you could see the theme, right? You could see how these Mag 7 names are really starting to wake back up and offer some signs of improvement via the higher lows that they are shaping up across the board. So loving the inside hammer. Show me over 358. Let's see if we can rock and roll for higher. It's going over this Broadcom. Nice resting bar. I personally have a vendetta against Broadcom. I know you shouldn't have vendettas in the market because, hey, an opportunity is an opportunity is an opportunity, but it just trades like absolute garbage. I know we joked around about that on Wednesday, and then it was higher on the Apple catalyst. That's fine. There are just certain names. Boeing is another one for me personally. It's literally on my no-fly list. Let me put it this way. Lifetime profits on the Boeing ticker in the red firmly, right? I don't think I've ever really had a firm grasp on the way Boeing trades. And Broadcom, the ledger is probably a little bit more mixed. And again, a chart's a chart, so shouldn't really have any type of feeling about it. But really tight inside day. I wouldn't call you nuts if you try something that looks like that. I don't know if it's more of a mechanics thing. Let me even just say it that way. The option spread are way wider than your NVIDIA's or any other Mag 7 name of the world. It's wider than Palantir. It's wider than Robinhood, right? So it's just pretty tough to get involved in that Broadcom there. Anyway, from an options perspective, the chart looks fine. Inside bar, reclaim the 50, test this gap, see if it can't get some upside drift. Let's jump on over to the meta chart. Can't touch this with a 90-foot pole until it builds out some more structure. Another one that's just like brutal. What do we do here? Opinions aside, technicals, it needs to tighten up. It needs to pull back, test the 200, look below and fail the gap. And, so a couple of situations. What are the scenarios? Sideways, break the inside bar, and we're higher midweek. Look below and fail the gap, tighten, and then we're in here. You could buy it on the reclaim and you could buy it on the break there. It could go for the gap close if you notice that it firms up. And keep in mind, there's additional gap into Thursday's high, not just this prior left side peak. But if we go into the 200, find buyers, maybe it is over Thursday's high, you could try to buy that gap fill reversal, tight risk, reward back up towards the highs. That's really it on Meta. Honestly, if this is a weekly balance range and this is a stage 1 base, stage 2 uptrend starts as we do that, right? So really paying very close attention to 678.50 on Meta. MU, let's keep this thing moving along. As much as I want to be bullish memory, and we talked about this with the DRAM, that's just a lower high. You're under the 20. You're underneath this overhead supply. I want to stick to the thesis of yes, memory is going to play a key bottleneck constraint in AI, and we're going to need more memory, and we're going to need to save all these disastrous AI GIFs and memes and AI images that people are generating with Grok and whatnot. So yeah, we need more memory, and it's for really important stuff like memes. If this lower high is going to be stuffed underneath 1013, I don't know how bullish I really want to get on MU, right? And again, very similar to the SMH ETF. Am I going to be the biggest bear as we start breaking down through the neckline? Probably not. I'd be watching out for the oopsie daisies, and then we're back to highs. But show me something a little bit more concrete. Show me something over this 1013s, and maybe we're talking back up towards this gap. So trying to keep an open mind to this MU and not get overly biased one way or another. But for now, it's not really doing what I want to see. Here's Tesla. Nothing to do on this in this balance range. Show me some firm action over 415.50, and we'll start to play ball there. In here, be my guest if you want to get chopped to bits. It's going over to JP Morgan earnings this week, of course, as we just saw. To me, this looks pretty good. This looks like a flag up here towards the highs, and can we just stay over the 20? Can we flag out here and continue up in the upward direction? Maybe. If this gap's down, it's still got a lot of protection. If this gap's down on earnings and can find a footing over the 50 SMA, I don't know what the measured move is yet, but over 315.50, I would maintain a bullish stance, even on an earnings gap to the downside. AMD, this is probably my A+ top watch setup into the early stages of this next week, primarily Monday. It's so good that I'm honestly frightened it's going to open on a gap up and the setup's going to be gone. If this market can cooperate, which it has not done, right? You have your tight day here. You ideally want to open in range, buy the break of the 2-day highs. It just gaps up, right? If this market can cooperate and open in range, this is a trade that I think everybody and their brother's mother's sister will be all over. And that's through the previous all-time high, 558.50, inside day high, just straight through that level to the all-time high. It makes a lot of sense to me. if it gaps up, it's going to be frustrating, but the plays there are pullback for gap fill reversal or Brigade bolt over the all-time high, being a believer that this breakout has legs. Have the breakout playbooks really been working well recently? I mean, you tell me. Breakout stuffed, right? Breakout stuffed, right? So it depends on if this market's going to go through a character change or not. We could try it with smaller risk and see if we get traction, and then sort of go from there and say, okay, well, there's one that's working. Let's see if we can get another, and go from there. But I would really prefer that we open in range rather than open on a gap up and try the breakout through the all-time high. So I think I've been pretty clear about that. That's my top watch into this week. And then here's this Intel, the old darling trade, if you will, is falling apart. And, I think everybody's clear on this, but I was sort of out of this thing in here. Very small profit on Intel, not nearly what I wanted it to be as a high tight flag breakout, but rules are rules. You sell the 20, you definitely are out under the 50, and you're just spending time under the 50. Could this be a daily high or low? Maybe. Is it a tight bar? Maybe. Are we buying that through the high there to get back to the 50? Not my first thought. Is that a weekly high or low? I don't know. This chart has a lot of I don't knows surrounding it. So for me, what does that mean? Less aggressive, patience, wait for the setup that's like as crystal clear as it can be. That's probably back to here. That's a double bottom. It's through the neckline. It's a gap close. Show me a higher low over the 50 SMA, rotate to the flag highs, right? If you're just gapping and chopping around down here, I really want to be less interested in Intel. All right, let's move into these 3 additional ideas, and then you're out of here for your weekend update, and I'm continuing vacation mode. What do we have on ARM? ARM's just a really tight inside day on Friday, where if we could break over the highs at this 329s, if we could break over that, very straightforward trade, right? You're targeting the 20 with like minuscule risk. The day is so tight. Again, barring any sort of gap, which you never know with weekend headlines. I haven't even been perusing weekend headlines, but if we can open in range, very straightforward. Show me, or even on a gap down that breaks through it, right, is straightforward enough. So ARM over 329, I like it. One of the reasons I like it as well is that this is a look below and fail, which brings us back over the neckline, if you will. Dare you even start to call that a head and shoulders, but look below and fail of these left side lows here, reclaim the 50, tight day, over the highs, pretty textbook stuff. If it runs back to the all-time highs, I mean, geez, what a blessing that would be. But, this is that infinity to 1 risk reward ratio. Shout out Mike. But ARM looks great there on a tight day. Based on the same premise here, we'll go Qualcomm as the next trade idea. You can see similarly, here's your sort of overhead supply. I actually tried it back over here, got stopped out, but would be willing to try it again on a look below and fail. Is this your high or low? Really tight day on Friday, back up through 190, 125. I don't love that we're under the 20, under the 50, but the premise here is look below and fail, right? So do we get something that does that? Again, minuscule risk. Look at how tight the day is. It's like, these, I don't want to call them free trades, but geez, you put on risk that looks like that, and you're able to run this, even if it's like a quarter or a half of the position back up to the all-time high. I mean, you'd be silly not to take trades like that in terms of the market. At least that's my view. So I'll be trying Qualcomm, ARM, and then the next one is RKLB, right? Last and final trade idea for you is, lo and behold, the same exact premise, right? Is this a little look below and fail of this area here? Is this support over the 200 SMA? It's such a tight day where, once again, you've got minuscule risk trying this off of the level, even if you just retarget the 20, right? I mean, geez. And that's assuming that you're going to use previous day's low as a stop and not the current day's low or some other logical level that comes from the 5 or 15 minute chart or whatever entry tactic you're using in there. So really tight risk spots on these 3 names that I found. And again, not that I found in my scans, but I'm sure many other people are looking at as well. Once again, that's ARM, Qualcomm, and RKLB here. And that is going to do it for today's episode and installation of the weekly watch list. So if you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. As always, we'll be live not tomorrow, but rather on Monday morning at 8 a.m. Eastern time for another episode and installation of the pre-market prep, building out a game plan for the day and session ahead. Hope to see you there. Enjoy your weekends. Keep it green this week. And as always, I will see you in the next one.